Hey everybody, welcome back to the Florida Stacker YouTube channel, and today we have my friend and a special guest, Lior Gantz, back with us for another quarterly update. Here we're going to discuss the current state of the market with a focus on how it will impact the price, as well as availability of gold and silver, and the impact on those that invest in equities and other markets as well. For my silver stackers out there, alarm bells are concerning at this time due to the amount of silver that has registered on the COMEX as well as the LBMA. It is a bit concerning, so I'm going to ask Lior about the potential for another silver squeeze during 2023. And lastly, we'll talk about the end of globalization, the demise of the Petro-Dollar, which is ongoing, and much more. So introducing Lior, he is the CEO of Wealth Research Group, where he heads a team of specialists who know the market. And I'll be sure to post links directly to reports that you can read that will help you prepare for this and the next market. Welcome, Lior. How are you doing today?
I'm doing good. Thank you for having me back.
Yeah, absolutely. Great to have you here. So, Lior, thanks for coming back. And as you know, the core audience here on the channel are buyers of gold and silver, to include physical coins and bars, as well as investing in the miners and royalty companies that bring precious metals to the market. So let's start out by talking about the opportunity metal, and that would be silver, and the probability of a silver squeeze in 2023 as precious metals begin to bounce around. But we're seeing them performing pretty well over the last couple of months. I know you mentioned a fairly low weight in silver that was registered on the COMEX and LBMA. So that's something I haven't seen, or we haven't seen, for over a decade. Can you tell me what's going on here?
Actually, the last time it was this low was in 2000. Do you know that Warren Buffett and Bill Gates bought a lot of silver in the late 90s when the price was... So if you research that story about Buffett, he bought a lot of silver. Bill Gates also bought a lot of silver. They both sold their positions for a very large gain. Buffett, to my knowledge, sold his last bits in 2004, but he made a lot of money with silver. And the last time the registered ratio, what you're talking about in the COMEX and in the LBMA, was this low, it was 2000. The early parts of an 11-year bull market for gold, the longest bull market of any asset class in the history of the world. In other words, the longest back-to-back consecutive uptrend years in any asset class ever was 11 years for gold between 2000 and 2011, including 2008. And silver during that run had a magnificent rally to close it, because what happened was in 2008, because of the bank failures, the price of silver went from $21, to $9 because of one bank going down, and it had to liquidate its long position.
Right.
And then on the flip side of it, it rallied from $9 to almost $49. I remember that vividly because I bought a lot of silver at 15 and sold it at 42, 45 to fund my wedding and my honeymoon. So I have I have a very a lot of sentiment therefore for silver. And what we're seeing now is, if you remember on our last interview, I said that the trend for precious metals will be up once the Fed starts to declare victory on inflation. In other words, once the Fed becomes convinced that disinflation is starting to kick in and it will slow its rate hikes, then counterintuitively, the price of precious metals will start to rise. And that's exactly what we've seen. If I'm not mistaken, I even talked about gold being around the 1900s or more in the first month of 2023, and that's exactly what happened. Silver has been the best performing asset class in the world in Q4. Of all the asset classes, of all the major asset classes in the world, silver was the best. And a few dynamics that are happening are, one, there have been talks between the Saudis and the Chinese about purchases of oil in yuan, basically dismantling the Petro-Dollar system. It's still very much, in its infancy, but that plays a role on what's going on. But what's even more interesting is China's flip on COVID policies, reopening the entire country. And that has helped to weaken the dollar a lot because money's starting to flood in back to China. And the third thing that's happening right now is that the U.S. economy, in stark opposite to the last decade, is actually the lagging economy in terms of the developed nations in GDP growth. Wow. And so these three things, and that's obviously on purpose because of the Fed trying to slow down the imbalances in the labor market, and we can talk about that a little bit. But the bottom line is that as we progress, the Fed at some point will stop raising rates no matter what happens with the job market. In other words, it will reach a point where the risk reward to keep raising rates in order to balance out the jobs market will not be worth it. I think that point will come in May. And at that point, I think that the price of gold and silver will even accelerate further. So right now, precious metals are rising, but every time there's a hot jobs report, they plummet. Every time Powell says, hey, we're winning the fight against inflation, they're rallying, but they're whipsawing, okay, on an uptrend, but they're still whipsawing. The clear runway is after the Fed says it's done. No matter what happens with the jobs report, we're not raising rates. That's the clear runway for precious metals. That's, I think, will come in Q2, or I'm sorry, more like H2 of this year, between June, July, and so forth. So I see a very good year for gold and silver for sure, on the backs of a weak dollar and the backs of the Fed stopping to raise rates, and on China's reopening. And we actually, I think that everyone should understand the dynamics between MBS. MBS is short for Mohammed bin Salman, the crown prince of Saudi Arabia, right, and what he's doing right now with President Xi. So if you haven't delved into it, I summarized the whole thing so it's easy to understand the dynamics that are happening under the hood. If you go to wealthresearchgroup.com/Saudi, SAUDI. So I think everyone should definitely read that, because that is that's a big deal. That is unwinding 52 years of the Petro-Dollar, basically.
Yeah, and as we know, gold and silver are valued in U.S. dollars. So what do you see the impact then on that, Lior? How do you see this playing out as far as other commodities priced in the dollar?
Yeah, so if you follow the Russia military operation in the Ukraine, then you know that America is changing its stance in the most dramatic fashion right now. From being the policeman of the Middle East, and basically for the last 52 years, making sure that the trading routes and the seas are open for their allies, so that the Saudis can supply America and its allies with cheap dollars, with cheap oil, so that they can run their economies. The United States is starting to go back in to becoming a supplier of energy and weaponry and everything else to the rest of the world, just like they did during World War II, where they didn't intervene at first, but they profiteered off of the war. So right now, because of what's happening, America is selling energy in the form of LNG, which is liquefied natural gas, but I think they will continue selling oil and everything else that they can to the European market and to other markets that will accept them. So from becoming from being sort of this overlord of the global economy and ensuring free the open seas, etc., they will now move to a position of business more than the business of policing. And I think that you'll see the defense industry in the United States and the energy industry in the United States starting to export finished goods. So that is a very nationalistic point of view, whereas for a very long time, it's been a globalist point of view. And as we a move from that world, and that's because of public opinion. That's the same people that voted for Trump, and the same people that said, "Hey, we've been to Iraq. I don't know what we did there. I don't know what we did in Afghanistan." This entire public sentiment has become so powerful that it's making it's making politicians go from globalist to nationalistic. And that's happening not just in America, but around the world.
We're seeing that in elections, Lior, in Europe.
Oh, yeah.
Italy is a good example, right?
Yeah. In my opinion, we're starting a 30 to 40 year period of 3 or 4 decades ahead of nationalism. We've deglobalized after probably 80 years of globalization, and we're starting this path of deglobalization. And that has huge ramifications, one of which is the necessity to have a global currency or a global reserve currency tied to oil. That will not be necessary to that degree that it was before. And therefore, the ramifications for the dollar are very bearish. And if you understand this dynamic, if you understand dynamic that America wants to now sell energy and sell defense instead of exporting its military and defending the waterways and cheap oil, you understand that this is a dramatic shift in U.S. foreign policy and in the way they do business. And I think that people who understand that are now bearish the dollar, or to the very least, they start to hedge their portfolio with gold and silver just a little bit. I'm talking institutional money. Right. So having 0.5% to 1% of your portfolio in gold and silver makes a huge difference to the price of gold and silver. And that's a dynamic that we will continue to see. And I think that people should definitely pay attention to that. And if you want to kind of have an idea of this whole chess match that's happening between Russia, China, Europe, and the United States, download wealthresearchgroup.com/Petro, because I went over it from A to Z, so you can understand that the energy markets are going to go from open and global, in other words, you buy it from the cheapest source, to closed energy markets. In other words, you buy it only from your allies. And that's a huge difference. Yep. It will make a difference in price. It will make a difference in premium. I mean, we are changing. The world is changing dramatically. And this is a very pivotal moment for the dollar.
Yeah, I would say so. So for my viewers out there, I will have links to these reports down in the video description section. Just go ahead and check that out down there. It'll take you directly to Wealth Research Group. I have to admit, Lior, when you talk about the United States exporting energy and weapons, that sounds a lot like Russia. And I'm wondering if the invasion of Ukraine has something to do with the United States stepping in to kind of fill that gap. Perhaps, even though I know we have obviously sold weapons, abroad for many years. Interesting. But Lior, I'd like to shift, if you don't mind, back to kind of more domestic North American topics like inflation and interest rate hikes. And it does look like the Fed is going to continue, as they promised, to raise rates, slightly, maybe 0.25 basis points. With each of these FOMC meetings. However, I noticed that when the rate hike came in, the market initially, dropped for about 30 minutes to an hour and then rallied to close even higher. Are you seeing that the market is already pricing in these future rate hikes? I guess I asked this question mostly because I'm curious to know if I should continue to dollar cost average into this market, or, if I'm being too cautious and maybe need to be a little more aggressive before the rest of the world catches up and catches on to the fact that we could be on the edge of something new here.
Okay, good question, and I'll tell you this: there's a watch tool for the Fed called the CME Fed Watch tool. You should have it open on your browser at all times, and it shows you exactly what's priced in terms of the bond market. And the bond market right now if you go March, May, June, et cetera, you can do that on the CME Watch tool. The market prices in a terminal rate. Terminal rate means the high end of where the Fed is going to take interest rates at 5.25. That's the consensus. We're currently at, so that is very much priced in. Okay. What's not priced in is what happens next. Because here's where the two camps are thinking differently. One camp says the Fed is going to understand that inflation is dropping, and therefore interest rates are actually too high, and it will start to cut rates. That's one camp. A second camp will say, hey, they're gonna tighten us into recession, then they'll need to cut. So they'll cut us into a recession, not into normality. That's the second camp. The third camp says, and I belong to that camp, that once they reach that terminal rate, they will do the same thing they did in 2011 with the zero interest rates. They will stay there for longer than anyone can imagine. And I think they will do that on the other hand. So they will stay at around 5% for longer than the market currently anticipates and expects. In 2011, if you remember, when they lowered rates to zero, everyone kept saying that's unsustainable, that it is, we've never had that, that's unprecedented, etc. It's temporary, it's all the things, and we stay there until 2015. Okay, because the Fed was deathly afraid that if they raise rates, they're going to spiral us into deflation. That was the fear back then. And so keeping it rates at zero, their thought process was, if rates are at zero, small businesses and individuals will start taking on mortgages and stimulating the economy. And sure enough, they did not do that. The zero interest rates loans went to the institutions and the big money, and that's how you got the wealth gap. So you had a plan where A goes to B, B goes to C, etc. The plan did not go as they thought, and created unintended consequences because they were afraid of deflation. Now they have something else. They're afraid of inflation. They're afraid that what they'll see is what we saw in the mid-70s, where the Fed thought it crushed inflation, it eased, and then inflation took off. That's what they're deathly afraid of. That you have it in Powell's words. So the last thing they want to mess with is easing too early. So I think that they'll stay there at that level of 5% for a very long time. And what they think it will create is more layoffs and a balancing out of the labor market. And again, unintended consequences will appear, and they will realize that no matter how long they stay there, we just have a demographic problem in America that a bank cannot solve. If you want more people to come back to the workforce, you need to deploy fiscal policies and not monetary policies. So it will not work, and it will create unintended consequences. Who knows what they are right now, but they will happen. And that's where I think we are. I think we're in a situation where the United States has about a shortage of between 2 and 2.5 million workers for the services economy. We don't have enough immigration of quality people to facilitate this. We don't have enough people coming into the workforce wanting to take those jobs. And we have an entire generation that's actually retiring, the baby boomers, and they have enough savings so that they don't have to take on jobs. So this dynamic between onshoring jobs, so you bring a lot of jobs back into the country, but you don't have enough workers, that's not something that keeping rates at 5% will solve. So you have this dynamic where the monetary policy would not answer it, just like it didn't answer the problems of 2011, because even rates at zero did not urge people to take on mortgages, and rates at 5% won't encourage people to go back to work. It doesn't work that way. The logic is not there. So I think that that's where we are. In America, we have a situation where inflation is divided into three things. It was goods or supply chains, etc. That's basically been solved. We have we had a hot housing market that's been solved. It's not hot anymore. In fact, it's super cold. And we have a third one, which is the services economy. And just to define the services economy, when we shut down for COVID, everyone that works in the services economy went to the goods economy, right? Because people did not do anything. Now, to lure them back is a problem. Some of them that went to the goods economy are staying there. Some of them quit and just retired. Others went to study for another degree because they thought they lost their career. It's not that easy to bring those 2 million people back. So the idea was, let's raise interest rates. These people in the goods economy will see the economy slowing down. They'll fire people. Those people will move there. And it's just not working out. So I think that we have inflation in the system way more than before, way more than in the past decade. And that's another reason that portfolios will need to hedge more for gold than in the past decade when we had disinflation.
Yep.
And in general, my thought is that the Fed will keep rates higher for longer, and that's a huge change in the economy for sure.
Yeah, I would say so. So, Lior, that brings me to my last question, and thank you for clarifying that they're not just two sides of the street right now, and I mean Wall Street, but also your perspective as well, that third angle. And my question is, with rates staying higher than we've seen them for the last decade, around 5%, if the Fed policy continues to play out, what will that do for gold and silver prices if, let's say, you're able to make a little income with bonds, certificates of deposit, or just by keeping some cash in the bank?
Yeah. So the obviously traditional conventional wisdom will tell you, hey, gold doesn't yield anything, and therefore gold will suffer, and silver will suffer because people have an alternative. They can deposit it in banks and make money that way. Just like on the flip side, the traditional wisdom was rates are at zero. Here we are in 2011. Gold will shoot to $5,000 or $10,000, and sure enough, it crashed to between from 1900 to nearly 1,000 in December of 2015. So the traditional wisdom is not wisdom, or the conventional wisdom is not wisdom. It basically tries to simplify very complex dynamics in the markets. Rates staying high mean a few important things. One, they mean that emerging markets will outperform the developed markets. And that historically has a lot of correlation with commodities going higher. Why? Because in an inflation environment, investing in infrastructure, because that flattens out inflation. If you invest in a project for 10 years, you basically flatten out the woes and woos of inflation.
Right.
In stark opposite of investing in tech, where you basically leverage disinflation. Or when you invest in growth, that's which is not happening right now. People are shying away from growth, and they are going to value. They are going to wherever value is created right now, not in the future, because the future is taxed with inflation. So when you look at that dynamic, you see a lot of potential for gold and silver, because if tech is underperforming and you need to start looking at alternatives, then you go to commodities. Yep. And that's why commodities tend to do very well in inflationary environments. And on top of that, in a dollar bear market, which is even more important for gold and silver than anything else. So I think you're already seeing that Powell's chief goal, which was to create a yield curve that's totally on the positive side. In other words, real yields are positive from the 2-year up to the 30-year. You're already seeing that they've tightened enough to where gold has bottomed. You can't tighten more. Everything is already, the real yields are already positive. So that is a one-way street. The one-way street is that financial conditions will start to ease, and we will be accustomed to this new normal. The $5.5 trillion that are sitting in money market accounts will start to go back to work. And as the economy expands and the dollars get spent into the economy, into equities, etc., gold will get elevated, and so will silver. So I think that in general, when you look at the dynamics, they're very favorable for both gold and silver, but specifically for silver.
Well, that's great news for viewers of this channel who are mostly gold and silver stackers like myself. So you think 2023 will be a good year for the precious metals then, Lior? Is now a good time to really pay attention to the metals and spot prices and perhaps get in the game if you're not already?
I would say as a buyer, it would be it would not be a good year because prices are going to go higher. As a buyer of physical, the physical precious metal buyers should buy a lot when the prices are going down. And so it was below 20, and gold was toying around with supported 1600s. But on the flip side, in other words, how do you capitalize on a bull market? I wouldn't buy a lot of physical. I would buy a lot of leverage. How do you do leverage? You do either options, ETFs, leverage ETFs, or mining stocks, because that's where a bull market can help you.
Absolutely.
Because you go in, you go out, you take the capital gain, you buy basically that gold and silver physical, but you buy it from the gains. So
Absolutely.
when you buy it from the gains, you offset the rising price. How? Because mining stocks have leverage over the price of gold. If the price of gold goes from 1900 today to 2200, that's basically a 15% move. But because as a miner, miners tend to mine at around 1100 all sustaining costs. So that means they have an $800 margin over the 1900. If the price of gold goes up by 15% to 2200, their margins go from now $800 to $1,100, and that's way more than 15%.
Yeah, much bigger gain.
Correct. So as you take that leverage, in other words, the price of gold goes up by 15%, your stock portfolio of 5 amazing gold companies has gone up by 50%. Now you can take that capital gain and offset any elevation in the price of gold and buy it for free. Basically, buy that leverage for free. So I think that is a much better strategy during the bull market, just as you would in a bear market, sell some of your physical to buy an even more depressed mining stock if that's something that you want to do. So that's how you use the leverage. I think the two other dynamics that people should pay attention to with regards to the dollar, just as I know you're trying to wrap the interview. One is Iran, two is CBDCs, which I can just briefly mention.
Yeah.
And three is the race to space, which I think should just interest people, because it's basically it's where WW3 has already started.
I see.
Okay, so with regards to Iran, definitely go and download like a summary that I create about Iran at wealthresearchu.com/Iran or Iran2. Iran, the number 2. Either of those are amazing as a companion. I think that they're important. And by the way, I have a front row seat to everything that's going on because I'm in Tel Aviv. So
there you go.
We're literally we're literally where this is aiming. So it's an interesting dynamic with what's going on right now in the Middle East. I think that if you read our newsletter and follow what's going on, I talk a lot about the dynamics right now in the Middle East because the Saudis and the Iranians are obviously arch enemies. The Straits of Hormuz, where oil leaves for the rest of the world, are going to be an interesting place if the United States fleet actually, starts to recede from there, and then there's a vacuum, and who comes in? Is it the Chinese? Is it the Russians? Will the Americans not leave? Who's going to secure this oil for the world? And there's so much going on. It's amazing. That's one thing. That's one dynamic. And Iran is going to get closer and closer to nuclear capabilities in 2023. So that's one thing. CBDCs are an interesting phenomenon that is already taking place in China in a big way.
Right.
About 90% of central banks are experimenting with them. Actually, America is very early to the game. Even Europe is more advanced.
We're talking digital currencies here, everyone. Just make sure that the audience is following along with CBDCs.
Oh, CBDC, central bank digital currencies. And so there's a lot of threats and dangers that this brings because people are afraid for their identities or getting canceled on a digital realm and everything like that. I think that if you want to truly understand it from A to Z, because I've explored this topic for months. I've looked at everything that the IMF, the World Bank, the Central Bank of Central Banks, the Bank of International Settlements, and all of their economists. I've looked at the body of work that everyone's done and all the pilot tests and programs that are happening between Thailand and China and everything else, and I put everything together. So if you want to really understand exactly what's going on with CBDCs, as current as it comes, it's the best update on what's going on. Check out those two reports on CBDCs because they go through everything that's happened in that world. It's wealthresearchgroup.com/CBDC and /CBDC2. Those are two reports. I think you should download both of them. One talks about the more rosy side of it, and one talks about the more dark side of it. So in other words, how can they be integrated and who can they help? And how can they be abused by governments if left unregulated enough?
Right.
So, but they are coming. They are coming. And in some form and degree, they are coming. And lastly, this race to space. It's really interesting what's going on right now because literally, if you look up, there's already a war going on, and that. That frontier.
You can look up and see it here in the United States these days.
Actually, you can.
Good point.
But if you look even further, it's literally on. It's on. America, China are the leaders. America by far is the leader right now in winning this race. But man, that race, that the odds are tremendous. And if you truly understand what dominating orbit or lower orbit means, it's the ultimate leverage on so many fronts. So I definitely read wealthresearchgroup.com/space. I'm sorry for giving out everything, but
it's great.
The interviews on YouTube, they get shorter and shorter every time I come on.
Yeah.
The host tells me, hey, you have 6 minutes or 7 minutes. So I'm like, okay, well, let me at least give the audience added value. So if on the weekend they take on these reports, each one of them is like a 5 to 6 minute read. So you can download them all. And if you're tuning out, you have no phone, you sit down, you understand that it takes you about 30 minutes to learn stuff that it's taken me months to put together and understand. So I think that space is a really important subject. It's the next big frontier. You're going to hear a lot about it. And currently America is a leader, but it will have to, there's so much more for it to conquest in order to stay the leader. And I think that in the world we live in, I don't know if dominating is the right strategy anymore. I think that coexisting is a much more healthy and sustainable way for our planet because by dominating today, in today's world, with the weapon capabilities that a country has, it's too much power for any country. So we need way more checks and balances than before. So anyways, fascinating topic. Definitely check it out if you want everything that I dished out today in 5 seconds. It was Wealth Research Group / there was Iran 2, CBDC, CBDC 2, space, Saudi, and Petro.
That's right. Yeah.
If you want to just in one fell swoop.
Absolutely. And hey, everyone, I will make sure to have those links once more down below so you don't have to go fishing for them. Just one click and you'll have it. And as mentioned, it's pretty short, pretty great reading, and no pun intended, but a wealth of information. So these are all just, reports to help you stay in tune with what is going on around the globe, within the markets, and how, certain geopolitical events and even the space race may determine the value of your portfolio going forward. So thank you, Lior. Thank you for being here once more. And I definitely look forward to talking to you again next quarter, and we'll see how all this plays out. So far, you've been pretty spot on. So thanks again. All links down below. Lior, any closing comments?
No, let's see gold at 2000.
Let's do it. All right, everybody. Have a great day, and we'll see you back soon on another Florida Stacker video. Take care, my friends.
Thank you for watching our video. I hope you subscribe to our YouTube channel.